Welcome viewers, my name is Peter. In this video, I am going to be showing you how to prepare consolidated financial statements. And this is the financial reporting intermediate level for those who are pursuing CPA. So let us begin by understanding what we mean by consolidated financial statements. So this is how we can define that. Consolidated financial statements are the financial statements of two or more companies prepared as if they were a single entity. In the financial accounting, the one that is dealt with in the CPA foundation level, you are taught how to prepare a statement of financial position, a statement of profit or loss, and a cash flow statement for one company. But in this level, you are preparing the same statements, but for two or more companies. So that process of bringing different financial statements of two companies into one is what we call consolidation. So the statements are called consolidated financial statements. So we are going to be preparing the first three in this level, and in the advanced level, that is when you are going to prepare the consolidated cash flow statement. So in the intermediate level, we only focus with the first three. So we are going to be preparing consolidated statements for different types of companies. So we have the types of companies dealt with in group accounts. These different types of companies, they get the name depending on the percentage of shares that have been acquired. For example, subsidiary, we define it based on the number of shares that have been acquired. It is a company in which another company has acquired more than 50% shares. In this case, the investing company has control over the other company, over the subsidiary. So the investing company is normally called parent company, or you can also call it holding company. If the percentage of shares acquired is 50% and above, that is when the company becomes a subsidiary. If the percentage is exactly 50%, that company cannot be called a subsidiary. It will be called a joint venture. But the percentage can go as high as 100%. So anywhere between 51% and 100%, that is a subsidiary. The second company is a joint venture. This is a company in which another company has acquired 50% shares. Control is shared by the two companies. So this has to be exactly 50% shares, because if it is 51%, then the company will be a subsidiary. And if it is 49%, then the company will be called associate. So a joint venture is where the shares acquired are exactly 50%. The third one is called an associate company. So this is a company in which another company holds 20% to 49% shares. The investing company has no control, but has a significant influence. So when it comes to voting, in this case, we are assuming that the percentage of shares you have is the same as the voting rights the other company has. So this means that although you are not the majority shareholder, you have a significant influence. You cannot dictate decisions in associate, but you can influence the decisions. Then the fourth one is called a simple investment. So this is a company in which another company has acquired less than 20% shares. The investing company has no significant influence. So majority of investments usually fall under this category: simple investment, where the company has no control and has no significant influence. In this level, we are not going to be dealing with simple investments. That one is supposed to be dealt with in the financial accounting in the foundation level. In this level, we deal with subsidiaries, and associates. Mostly we deal with those two, and to some extent, the joint ventures. So when you want to prepare consolidated financial statements, we are going to see the steps you're supposed to follow. So here is the first step. The first step in the consolidation process is to calculate the percentage of holding. In the exams, sometimes they do provide, most of the time they provide the percentage of holding, which means you don't have to calculate that. But if you have a question where the percentage of holding is not provided, you have to start by calculating that. You're going to be using this formula. We say that percentage of holding is equals to number of shares acquired. You divide by total number of shares in the acquired company, which can be a subsidiary, it can also be an associate, and then you multiply by 100. So the percentage of holding that you get here will determine the accounting procedures that you are going to follow. According to the second point here, it says the percentage of holding helps to determine whether the acquired company is a subsidiary, an associate, joint venture, or a simple investment. So if you get more than 51% as the percentage of holding, the acquired company will become a subsidiary, and the accounting procedure for subsidiaries will be applied. If you get between 20% and 49%, the acquired company will be called an associate, and the accounting procedures for associates will be applied. So this is the first step that you're supposed to do. Once you have completed this step, then you go to the next thing, which is calculation of goodwill. So what is goodwill? We can define goodwill as follows. Goodwill is the difference between what the parent pays to acquire the subsidiary and the parent's share of the fair value of the subsidiary's net assets at the date of acquisition. Although we have used subsidiary in this case, it can also be an associate. The difference between what the parent pays to acquire the subsidiary or the associate and the parent's share of the fair value of the subsidiaries or the associates' net assets as at the acquisition date. So it is what you pay versus what you get. The value of what you get, you compare with the price that you pay to get it. So goodwill can be of two types, positive or negative. Positive goodwill occurs where the purchase consideration, that is the price paid to acquire the company, is higher than the fair value of assets acquired. This goodwill is an intangible asset. In case of subsidiaries, it is shown under non-current assets. So positive goodwill, in simple words, is when the parent pays a higher amount than what they are acquiring, than the value of assets that they acquire in the other company. Negative goodwill is the opposite. Although this one is quite rare, it means that the purchase consideration is lower than the fair value of assets acquired. If we get a negative goodwill, we cannot call it an intangible asset. It is the same thing as a discount because you pay less than the value of what you are getting. And how do we account for discount received? Discount received is usually treated as an income in the profit and loss account. So in this case, negative goodwill should be written off as an income, the whole of it, in the profit and loss statement. However, negative goodwill is very rare. So in most cases, we are just going to be dealing with positive goodwill. So when it comes to subsidiaries, there are two ways of calculating the goodwill. Goodwill in subsidiary can be calculated using either the full goodwill method or the partial goodwill method. Partial goodwill method means that only the parent's goodwill is calculated. In this case, we take the purchase price paid by parent, then we deduct the parent's share of net assets. So if the parent has acquired 80% of the subsidiary, then we take the net assets of the subsidiary, we multiply them by 80%. So we take the share of the parent. We also have the full goodwill method. So this one is used, it combines the goodwill of parent and the minority or the non-controlling interest. In this case, we take the fair value of parent's investment. That is the price paid by the parent to acquire the subsidiary. And then we add the fair value of non-controlling interest, which will be provided. Once we add those two, we deduct the fair value of net assets of subsidiary. So the difference is that here, we will not multiply the net assets of the subsidiary with a percentage of the parent's holding. We will take 100% of the net assets of the subsidiary. We deduct them from the price paid by parent plus fair value of non-controlling interest. So let us look at the format that we normally use to calculate goodwill. Using both methods, on one side we have the format for partial goodwill method. On the other side we have the format for full goodwill method. The account we normally prepare to calculate goodwill in subsidiary is called cost of control account. On the debit side, when we are using the partial goodwill method, we only show the purchase consideration, which is the price paid by the parent to acquire the subsidiary. Then on the credit side, we show the fair value of net assets of the subsidiary. So the net assets here refers to items classified as equity and reserves. Equity and reserves is made up of ordinary share capital, pre-acquisition profit, revaluation gain, share premium. Anything that is classified as equity and reserves should be shown here as at the date of acquisition. Because this is the partial goodwill method, we don't take all the net assets, we take the share of the parent. So that is why here in brackets we are taking the percentage of parent. Every item that we show here, we multiply by the percentage of the parent. So once you have shown all the items shown under the equity, including revaluation gain, which may be given in the additional information, the balancing figure, which usually comes on this side, is what we call goodwill. So goodwill will be the balancing figure of this account. And when it is on this side, it means it is a positive goodwill, which is a non-current asset, an intangible asset. It means purchase consideration is higher than the fair value of net assets acquired. So that is the format we use under the partial goodwill method. So when you go to the full goodwill method, only a few things will be added. One, we are going to add the fair value of non-controlling interest. In addition to what we had here, we still have this one, purchase consideration, price paid by parent. We add the fair value of non-controlling interest. And then when you go to the fair value of net assets, we don't multiply by the percentage of parent, because this is the goodwill of the entire company. So we take the equity and reserve items 100% without apportioning. So if the parent has acquired 80%, here we take ordinary share capital 100%. Everything, the same items we had here in the partial goodwill method, they are the same items we have here, but we don't multiply by the percentage of the parent. The balancing figure will still be goodwill, but this goodwill now belongs to both the parent and the non-controlling interest. It is goodwill for the whole organization. So that is the second thing in the consolidation process, calculation of goodwill in subsidiary. Once you have this, we are going to see what you're supposed to do with the goodwill once you have calculated it, and also how to calculate goodwill for associates. So first, we want to see how to calculate goodwill in associate. Goodwill in associate can also be called premium. We use the same format. This is not a T format account. It is a statement, but the same items we had in the cost of control account are the same items we have here. The difference is the arrangement. So we start with the purchase consideration. This is what the holding company paid to acquire the associate. Then we have the fair value of assets acquired. You take the same items which are classified under equity and reserves in the balance sheet of the associate. You multiply by the percentage of holding of the acquiring company. So you add them, you deduct from the purchase consideration, you get goodwill or premium, which is the balancing figure. So it is the same way as the way we do it in the subsidiaries. But we don't call this one cost of control because the holding company does not control the associate. Once you have found the goodwill, there is something called goodwill impairment. Goodwill impairment is the loss of value in goodwill. You can think of it as depreciation. The physical assets, they normally depreciate, they lose value, but the non-physical, the intangible assets, they go through impairment. We amortize the intangible assets, but the accounting treatment for goodwill impairment is the same as depreciation for fixed assets. So goodwill impaired is treated as follows. We have goodwill impaired in subsidiary. If we are using the partial goodwill method, then you take the amount of goodwill impaired, you debit profit and loss account, and then you credit goodwill account. So because this is the partial goodwill method, the minorities will not have a share of the goodwill impaired. But when we go to the full goodwill method, because we have goodwill for both the parent and the minorities will also have a share of goodwill impaired. So the amount of goodwill impaired will be recorded as shown here. You debit parents, the parent share, you debit profit and loss, debit profit and loss with parents share, debit minority interest with minorities share, credit goodwill account with the whole amount. And then when you go to the associate, goodwill impaired in associate will be recorded as shown here. Debit profit and loss account, credit investment in associate account. So we don't show goodwill in associate in a separate line by itself, the way we do with the goodwill for subsidiary. Instead, we prepare an account known as investment in associate account, where goodwill impaired is credited. So that is a very important step in the consolidation process, the calculation of goodwill, which is usually a must for students to calculate that in an exam case. So once you have the goodwill, it is possible to prepare consolidated income statement, and it is very simple. In fact, the workings require more time. The workings are more complicated than the consolidation itself of the income statement. So we have the steps or the procedure of consolidating the income statement. So in number one, we say that income and expenses, add income and expenses of the parent to those of the subsidiary. Do not multiply with the percentage of holding. If the parent holds 80% of the subsidiary, do not multiply 80% with the sales, with the cost of sales, expenses of the subsidiary. Take 100% of income and expenses of the subsidiary and add them to those of the parent. But when you go to associates, if there is an associate, do not add income and expenses of the associate to those of the parent. So we do not consolidate the associate's income statement. We only consolidate the subsidiary's income statement with that of the parent. There's another adjustment we normally make when you are consolidating the parent and the subsidiary's income statement in case of a mid-year acquisition. So mid-year acquisition is where the subsidiary is acquired in between the financial year. So what we do, we apportion the income and expenses of the subsidiary pro rata to time. That is, according to the number of the remaining months. If the financial year begins on January and ends on that 1st December, the acquisition takes place on 1st July. It means you have to take only half of the income and expenses of the subsidiary because we had 6 months remaining to the end of the financial year. So that is the main adjustment that is supposed to be made during the consolidation process. Another adjustment we should make is to eliminate intercompany payments. Intercompany sales are eliminated from both sales and cost of sales. Also, eliminate intercompany dividend. When the subsidiary pays dividend, part of that dividend will be received by the parent. So it will be an income to the parent and it will be an expense to the subsidiary. Since it is the same amount, it is supposed to cancel out. So go to the investment income, if you have it, deduct dividend from subsidiary, also dividend from associate, and then in the consolidated income statement, you're not going to deduct any dividend paid by subsidiary. So as you can see, the format is the same as any other income statement, but here, if it is sales revenue, you take the parent's sales revenue, you add to subsidiaries sales revenue, you do the same with the cost of sales, you do the same with all the expenses, but once you have profit after tax, you are going to add share of profit after tax in associate. So remember in step 2, we said we don't consolidate income and expenses of the associate to those of the parent. But when you are preparing the consolidated income statement, where an associate is involved, you only show a share of profit from the associate. So take the percentage of holding, you multiply by associate's profit after tax. The amount you get, add it to the profit after tax. And then you're supposed to less minority's share of profit after tax in subsidiary. So remember here we said we don't multiply with the percentage of holding. That is what number 1 says. Do not multiply with the percentage of holding. So you have taken 100% of subsidiaries' income and expenses. So here, you're supposed to deduct the share that belongs to the minority so that you are left with the share that belongs to the parent. If the parent holds 80% of the subsidiary, you are going to take 20%, which is the minority. You multiply by subsidiary's profit after tax. So when you deduct it from the profit after tax, you'll be left with 80%, which is the share the parent claims from the subsidiary. So we have common workings in group accounts. So group accounts is usually hard because there are too many workings involved. First, there are 4 accounts which you are supposed to prepare. These are the accounts prepared and they are part of your working. You start with the cost of control, which is prepared to determine goodwill. So you have already seen how to find goodwill, but you have 3 other accounts you are supposed to prepare. You're supposed to prepare a statement of change in equity, which is the same as a retained profit account. The same items we normally include in retained profit account are the ones you're going to show in a statement of change in equity. You're also going to prepare minority interest account, also known as non-controlling interest. And lastly, investment in associate account. Those are accounts which you have to prepare as part of working. We have other workings which don't require you to open an account. Most of the questions require you to calculate an realized profit, which can be either from intercompany sale of goods or intercompany sale of fixed assets. You'll also have depreciation adjustment, which arises from revaluation gain. It can also arise from intercompany sale of assets at a profit. You can also have goods in transit, cash in transit. These are some of the common workings you're going to come across in group accounts. So we want to see how to do each one of these workings. Group retained profit account is also known as a statement of change in equity. It is prepared to find the value of retained profit to be shown in the statement of financial position. Some adjustments that are not done in the income statement should be done here, e.g. depreciation adjustment, unrealized profit, and dividend paid by parent. So this is the format we use for retained profit account. When you are preparing a statement of change in equity, you may not have to use the T format, but the items will be the same as the ones we have here. So on the credit side, you start by retained profit balance brought down of the parent only. So we won't have balance brought down of subsidiary. We won't have balance brought down of associate, only the parent at the year beginning. Then to that, add the retained profit for the year attributable to the parent. So this is your answer, your last figure in the consolidated income statement. That is the one you bring here, you already have it. Then from there, you add share of post-acquisition profit of subsidiary, excluding the current year, because the current year, the share of profit has already been included in the retained profit for the year attributable to the parent. So you just show the post-acquisition profit of subsidiary if there is any for the previous years. Don't include the pre-acquisition profit of the subsidiary. And when we say share, it means you multiply by the percentage of holding of the parent. Similarly, for the associate, add a share of post-acquisition profit of associate, excluding current year, because current year's share of profit has already been included in the amount shown here, retained profit attributable to the parent for the current year. So you only include any extra post-acquisition profit, except for the current year, you do not include pre-acquisition profit. Then on the debit side, we only deduct dividend paid by the parent, dividend paid by associate, and dividend paid by subsidiary should not be recorded here. And then goodwill impaired, if the minority have a share of goodwill impaired, when using the full goodwill method, here you are supposed to bring the parent's share of the goodwill impaired. Similarly, unrealized profit, you bring the parent's share. If the minority had a share, That will be taken to the minorities account. Depreciation adjustment, parent share. So everything here, you take the share of the parent, which means you multiply by the parent's percentage of holding. So the balance carried down, this is the figure you are going to take to the consolidated statement of financial position under the equity and reserves section. So this is the format you can use to calculate the retained profit to be taken to the balance sheet or the statement of financial position. So next we have minority interest. So first, if you are not aware what we mean by minority, minority refers to the percentage of holding that does not belong to the parent, and it is usually less than 50%. So if the parent holds 80% of the subsidiary, then minority's share is 20%. So minority's share will always be less than 50%. It is the percentage that does not belong to the parent. So there are two ways of preparing the minorities account depending on whether the partial goodwill method or the full goodwill method is used. So this is one of the formats. It is used when partial goodwill method is used. So we bring all items classified under equity and reserves. Equity and reserves, such as ordinary share capital of the subsidiary, share premium of subsidiary, retained profit of subsidiary. This one is both pre and post acquisition. Revaluation reserve of subsidiary as at the date of acquisition. Each one of these should be multiplied by the percentage of minority. So all items shown under equity and reserves of the subsidiary should be brought here. You take the minority's share. Then on the debit side, any expense that can be shared by the minority that was not included in the consolidated income statement should be brought here. For instance, we have an unrealized profit. Bring the minority's share here. Depreciation adjustment, minority's share. Any other expense that minority have a share should be debited in the minority's interest account. So balance carried down normally will be on this side, and it will be taken to the statement of financial position under equity and reserves, the same place we are going to take the group retained profit. So this is the format you can use to find minorities' interest when partial goodwill method is used. But when the full goodwill method is used, the format is a bit different, especially on the credit side. We do not show the ordinary shares, the share premium. We don't show those items, including the revaluation gain. We don't show them here. Instead, for you to use the full goodwill method, you must have been given the fair value of non-controlling interest. The fair value of non-controlling interest includes all those items in one figure. It includes their share of the ordinary share capital, share premium, revaluation gain as at the date of acquisition. The only thing the fair value of non-controlling interest does not include is the post-acquisition profit, because fair value of non-controlling interest is usually given as at the date of acquisition. So anything happening after the date of acquisition will not be included in the fair value of non-controlling interest. So that is why we are adding share of post-acquisition profit of subsidiary. We multiply by their percentage, because that one was not included in the first figure, the fair value of NCI. And then when you go to the debit side, we don't have any change. It is the same as the partial goodwill method. Any expense, any adjustment where the minorities had a share will be shown on the debit side. The balancing figure, will be taken to the statement of financial position under equity and reserves. So anytime you are given fair value of non-controlling interest in a question, use this format. If you are not given fair value of non-controlling interest in the question, use the previous format. Next, we have investment in associate. So this is how we account for investment in associate. Investment in associate is accounted for using the equity method. And in some cases, the equity method is also used to account for joint ventures. So if you know how to account for associates, you can also account for joint ventures using the same equity method. So under the equity method, the investor does not consolidate the associate line by line, but instead records the investment initially at cost and subsequently adjusts the carrying amount for its share of the associate's profit or loss and other comprehensive income. In short, the investment in associate account is helping to explain it in a clearer format, in a clearer way. On the debit side, show the purchase consideration, the price the holding company paid to acquire the associate. That is the purchase consideration, and it is what we call the initial recognition. Record the investment initially at cost. That will be shown under non-current assets of the parent. At the end of the year, this value will be adjusted because the parent will share some profit from the associate. That profit is called post-acquisition profit because it is profit after the date of acquisition to the balance sheet date. So take the percentage of holding, multiply by post-acquisition profit in associate, and you add it to the purchase consideration. That means the investment has gained value because of the profit the holding company has gained from the associate. But the investment can lose value. If the investment loses value, you credit. For example, goodwill impaired. It is going to make the investment to lose value. So goodwill impaired will be credited in the investment in associate account. And then from there, you can find the balance carried down, which is going to be shown under non-current assets of the parent company. Because we don't consolidate associates with the parent. Instead, we show investment in associate account as a non-current asset. So that is the simple way on how we find the investment in associate. Then from there we have some other workings. So far we have seen the 4 accounts which you must prepare during the consolidation process. But apart from the 4 accounts, we have other workings which do not require you to open any account, but you're just going to adjust them, especially in the statement of financial position. One of them is goods in transit. These are goods sent by one company to the other company, but at the end of the financial period, the other company has not received the goods. So goods in transit should be adjusted in the books of the entity that is supposed to receive them. Entries in the books for the goods in transit are as follows. So this is how we normally account for it. Debit group inventory. Credit group creditors. It is as if you have purchased goods on credit. How do you record goods purchased on credit? They increase your inventory. So your inventory has increased, so you debit inventory. You have not paid for the goods. So your creditors have increased, you credit creditors. And then you have cash in transit. Arises when one entity has remitted some money to another entity, but the cash has not been received at the end of the year. Cash in transit is adjusted by adding it to the cash or bank balance in the books of the entity that is supposed to receive it. So entries in the books for cash in transit. So one company has already adjusted. If you send cash, you credit your cash book. Then the one who is supposed to receive the cash is supposed to debit their cash book, but they have not debited their cash book. So during your adjustments, you're going to debit the cash and the cash equivalent. Then you credit group debtors. So a simple way to remember this: assume a debtor has paid you. How do you record a debtor who has paid you in cash? Because your cash has increased, you debit your cash book. The debtors have decreased, you credit the debtors. So in cash in transit, assume a debtor is paying you, so you record. Goods in transit, assume you have purchased goods on credit, you record the same way you would record purchases on credit. The next working, we have unrealized profits. So unrealized profit arises when goods sold to a group member remains unsold at the end of the financial period, which means the profit is within the companies. When you sell goods to outsiders, the profit is gained. But when you sell goods within the same people, within the group of companies, the profit remains within the companies. We call it unrealized because it is still within the group. To avoid profit overstatement, unrealized profits should be eliminated during consolidation. However, the elimination of unrealized profit depends on which company sells to the other. Sale of goods by subsidiary to the parent. In this case, the minority will have a share in the profit. The following entries will be made to eliminate the unrealized profit. Unrealized profit. It is only calculated on the goods that have not been sold outside the group. If the goods have been sold to customers, it is no longer unrealized profit. So it is only on the intercompany sale of goods where the goods are still within the group of companies. If the subsidiary has sold the goods to the parent, it means the subsidiary has made that profit. Any profit made by subsidiary, minorities will have a share. Therefore, our entries will be as follows. Debit group retained profit account. Take the percentage of parent. Debit non-controlling interest or minority account, the percentage of minority. Credit group inventory account with the whole amount. That is, if the sales were made by subsidiary to the parent, but if the goods were sold by parent to the subsidiary, the profit is made by the parent, which means the minorities have no share in that unrealized profit because minorities are in the subsidiary, not in the parent. In this case, the minorities will not have a share in the profit. The entries will be debit retained earnings with the whole amount, credit group inventory with the whole amount because there is no share for minority. Everything is taken by the parent. So NB, unrealized profit, is only calculated on the unsold inventory. Here is the formula. Unrealized profit on closing inventory is equals to profit margin. You will be given that, for example, 20% profit margin multiplied by unsold inventory. If half of the goods were unsold, those are the goods you are going to take and multiply by the profit margin to get unrealized profit. So we also have other unrealized profits. In this case, is from intercompany sale of fixed asset. This occurs when the parent sells a fixed asset to the subsidiary at a profit or vice versa. Somehow similar to intercompany sale of goods, but here the profit is always unrealized because the asset is not going to be sold to customers. The asset is going to remain within the group. So the entire profit made by the selling company is going to be unrealized and has to be eliminated. So since the asset is not meant for resale, the profit recognized should be eliminated on consolidation. So unrealized profit is equals to sales value of asset, the amount the selling company charged when selling the company, multiplied by the profit margin. Or simply said, take the entire profit that was made in the intercompany sale of fixed asset. All that profit is unrealized profit. So for you to eliminate unrealized profit on intercompany sale of asset, these are the entries. If asset is sold by parent to subsidiary, minorities will not have a share. We are going to debit retained earnings account, credit property, plant, and equipment account. If asset is sold by a subsidiary to parent, debit retained earnings, parent's share. If the subsidiary is selling to parent, it means the minority will have a share of that unrealized profit. So debit minorities interest account with minorities share. Credit property, plant, and equipment with the whole amount. So anytime there is intercompany sale of fixed assets and the asset has been sold at a profit, there is going to be a depreciation overcharge. Depreciation overcharge occurs when the company buying the asset calculates depreciation based on the sales value instead of the initial carrying amount or the cost. Depreciation overcharge is equals to depreciation rate multiplied by unrealized profit on fixed asset. Once you have the depreciation overcharge, you are going to make the following adjustments. If the asset is sold by parent to subsidiary, because you had overstated expenses, you're going to make an adjustment to reduce those expenses. So debit property, plant, and equipment. Because you had understated the asset, now you have to add the value back to the assets account. You had overstated the expenses, you have to credit retained earnings account. So this is if the asset is sold by parent to subsidiary. If the asset is sold by subsidiary to parent, the minorities will have a share in the depreciation overcharge. So the same entries we have here are also going to be here, but we are going to include a minority interest account where we are going to show the share of minority, and the retained earnings account we are only going to show the share of the parent, while the total amount will be debited in the property, plant, and equipment. We have another depreciation adjustment which normally comes anytime the assets have been revalued. If there is a revaluation gain, then automatically, without having to be told, you have to calculate depreciation adjustment. Usually, companies provide depreciation using the old figures, using the old values which are less than the revalued amount, which means they understated the depreciation. So when an asset is revalued, depreciation should be based on the new value. Depreciation undercharge occurs where the initial depreciation was calculated based on the old value, which is usually less than the new value. Depreciation under charge is equals to depreciation rate times revaluation gain. So you take the revaluation gain, either you multiply by the depreciation rate, or if you are given the number of useful life in years, you take the gain, you divide by those years, then that is the amount of depreciation under charge. So you're going to make the following entries with the revaluation gain. So during the consolidation, take the whole amount of gain, debit group property, plant and equipment account, credit cost of control, parent share, credit minorities interest, minorities share. So we are not going to create a revaluation reserve in this case, because these are the entries we are going to make. Then with the depreciation under charge, debit retained earnings account, because expenses were understated. So now we are adding to the expenses. And then the asset was overvalued. So we credit property, plant and equipment, because we had provided less depreciation. So you have to deduct it from the assets account. So this is the last part. After you have done all the workings, the last thing you should do is to prepare the consolidated statement of financial position. Do not prepare the consolidated statement of financial position without finishing the workings, because most of those workings require to be adjusted in the statement of financial position. So we don't have the format. The format is usually the same as any other statement of financial position, except for these items that have been mentioned here. So we have the consolidation procedure. Number one, add the assets and liabilities of the parent to those of the subsidiary. No adjustments are made for percentage of holding or mid-year acquisition. If the parent has acquired the subsidiary 1 month to the end of the financial year, you are going to take 100% of the assets and liabilities of the subsidiary. So we don't apportion the same way we did in the income statement, because this one is prepared as at that time, not for the year. Then do not consolidate share capital, share premium, or other items classified as equity and reserve. That is because only the parent's share capital should be shown. Then the last one, eliminate intercompany debts. Make the following entries to eliminate the debt. Debit accounts payable, credit accounts receivable. That is, if the parent owes the subsidiary some money, or the subsidiary owes some money to the parent, one company records it as accounts receivable, the other company records it as accounts payable. So they're supposed to cancel out, because it is the same amount. It is the same amount involved. And then during the consolidation process, the cost paid by the parent to acquire the subsidiary and associate is eliminated. So in the next video, where I'm going to be showing you how to perform the consolidation using a real question, you will be able to see how that is done. So the format for the statement of financial position remains the same, except for the following items. It remains the same as any other statement of financial position for one company, except for the following items. Goodwill in subsidiary and investment in associate are shown under non-current assets. You're going to deduct goodwill impaired. The net amount is going to be shown as goodwill. The balance in minority interest account and retained profit account are shown under equity and reserves. Other adjustments are made as explained before, e.g., unrealized profit, depreciation adjustment, revaluation gain, etc. So that is the end of this presentation. Watch the next video if you want to see how to implement all those procedures using a real question. So thank you for watching. See you next time.